So welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. In front of your screens, you have Euro USDs for our chart. All charts to be presented are to be of the same time frame, unless otherwise stated. At this point, we have to note a relative stabilization of Euro USD. That's just below the 1.0830 resistance line. It's characteristic how, despite the pair still marking lower peaks, it has failed to provide a lower true. So that tends to imply a relative stabilization. The RSI indicator, though, is still between the readings of 30 and 50, nearing a little bit towards 50, but still unconvincing. Nevertheless, for the time being, we tend to maintain a bias for the sideways motion to continue, probably revolving around the 1.0830 axis. Should the bulls take over, we may see the price action breaching the 1.0830 and aim, if not breach, also the 1.0955. On the flip side, should the bears take over, we may see the price action aiming for the 1.0740 support line. Let's have a look at USD/JPY. So USD/JPY maintained a clear-cut sideways motion. It's characteristic how the price action remained well within the boundaries set between the R148.60 and the S146.60. I would be noting here also the Bollinger Bands, which tended to remain at rather narrow space, more or less highlighting less volatility for the pair, which could exactly allow the sideways motion to continue. The RSI indicator remains near the reading of 50, implying a rather indecisive market. Yet, I would be highlighting on the fundamental level the release of the Fed's interest rate decision later today as the key event which could alter the pair's direction. Now, the bank is widely expected to remain on hold, with Fed funds futures implying a probability of 98% for such a scenario to materialize at the time being. I would expect the interest rate part of the decision to be an open and shut case. That's not the question. The big question mark here is the tone of the decision. And that's going to be revealed by the release of the accompanying statement and Fed Chairman Powell's press conference a little bit half an hour later. Now, let me rephrase that. On the one hand, we have easing inflationary pressures and a hit on economic activity, especially for the manufacturing sector of the US. Now, should the release more or less be tilted towards the dovish side, that may more or less force the US dollar to weaken, as it would be reconfirming the market's expectations for extensive rate cuts over the coming year. Mind you that the market currently seems to be expecting 5 rate cuts within the year, with the last one being December. And we have to note that there has been a shift in the market stance. It's characteristic that the market was expecting an even more aggressive dovish policy, i.e. more extensive rate cuts. It was expecting 5-6 rate cuts within the year. Now that has been curtailed to only 5, with the potential of them becoming 4. So more or less a dovish tone would more or less support, once again, let me rephrase that, a dovish tone would be more or less reaffirming the market's dovish expectations and could weaken the US dollar. On the flip side, we see that the US employment market remains rather tight. At least the December picture was quite tight, given that we had a drop of the unemployment rate. We had an NFP figure which was expected to drop. It didn't. It actually rose above 230K. And that may force, or let me rephrase it again, may allow the Fed to maintain rates high for a longer period. Now, should that be the case, and should the bank more or less try to keep its options open by maintaining a hawkish tone that may provide asymmetric support for the US dollar and actually push USD JPY higher, thus breaching the 148.60, possibly breaching also the 149.70 and starting to aim for the 351.85. On the flip side, should the bank sound dovish enough, we may see USD JPY slipping given the weakening of the US dollar, breaching the S1 146.60 and start taking aim of the 144.45. It's going to be interesting to see what the market reaction will actually be at the time of the release. However, please note that volatility may and most probably we expect it to extend beyond the time of the release as such. Also during Fed Chairman Powell's press conference half an hour later, it's going to be lasting, usually it lasts at around 1 hour, 1.5 hours. So in such a case, we may see increased volatility. Mind you that the Fed Chairman Jerome Powell has been well known to be a game changer in the market, be able, say, for example, to reverse a market sentiment which was initially created by the release of the accompanying statement and the interest rate decision. So do not be surprised that should the US dollar take one direction at the release, yet reverse that direction at Fed Chairman Powell's press conference later on. Yet the release as such is also expected to have wider effects, wider repercussions beyond the FX market, with ripple effects practically being expected to be felt also on US stock markets. Let's have a look at US 30, that would be Dow Jones. Now Dow Jones has a clear-cut upward trend line guiding it, and it would be interesting to note it at this point. Now some have mentioned that we had this one and it was interrupted, and now we have a new one, like here. In my opinion, I would be treating the stabilization as a confirmation of the upward movement, given that it was continued. And in that case, I would be shifting the initial upward trend line to the right a bit. It's characteristic that on a daily basis, Dow Jones continued to rise yesterday, something that was not the case with other US stock market indexes, say, for example, S&P 500 or even NASDAQ, especially NASDAQ, it dropped. For the time being, we tend to highlight the reversal of the 38,000 barrier from a resistance line to support line. The index is moving at record high levels, and at this point, let's set the new resistance level at 41,000. And let's correct those to the labels. Starting with the S3 now being placed at 35,940. The S2 at 37,100. The S1 at 38,000. The R1 at 39,000. The R2 at 40,000. And the R3 at 41,000. Now, fundamentally speaking, a possible dovish tone of the Fed could support US stock markets in the sense that it would allow for the market expectations for an easing of the tight financial conditions in the US economy to emerge or to be enhanced. On the flip side, a possible hawkish tone on behalf of the Fed could actually weigh on US stock markets. Now, at this point, on a technical basis, okay, the outlook is clear-cut bullish, and that's been supported by the price action as such over the past 10 days, despite some corrections here. Mind you, this is the daily chart anyway. And I would be also noting the RSI indicator, which has risen from a little bit higher than 50, has breached the reading of 70, and is now above it, more or less implying a strong market sentiment for the bulls. On the flip side, though, it may be also implying that the index is in overbought territory and may be ripe for a correction lower. Mind you also that the price action in the daily chart is flirting with the upper Bollinger Band, which may be slowing down the bull somewhat or create some hesitation. At the same time, I would be also noting here that the fact that it is at record high levels allow me to drill out to the monthly chart. You can see that there has been no such levels reached in the past. It's very, very characteristic how US stock markets have moved upwards in the past 3 months, 2 months, and this one. And we're ending January anyway. So, more or less, that may provide a feeling for the bulls that they may have overreached and could weigh on US stock market somewhat, especially the Dow Jones, which has not shown any correction for the past 4 days. If we move to NASDAQ, we see a different picture. That's interesting. You can see how NASDAQ has been correcting lower over the yesterday and during today's European session. It's futures, yes, but it's interesting to note that also the RSI indicator has dropped below the reading of 70 and is now aiming for the reading of 50. And that tends to imply that the bullish sentiment has faded away, which is a little bit worrisome. For the time being, though, we highlight here that the upward trend line remains intact. So the bullish outlook is still there, given the fact also that the 50 and the 100 moving averages, the green line and the orange line, continue to point upwards, as does the 20 moving average, which is the median of the Bollinger Bands. Should the bulls maintain control over NASDAQ, we may see the price action rising and aiming for the 18,000 support line. On the flip side, should the bears be in charge, we may see the price action reversing, breaking the upward trend line, signaling the end of the upward movement. But I would require also a breach of the S1 16,980, which used to be a resistance line. Yet, given that the price action has moved above it, we have reversed that into a support line. It's interesting also in the candlestick formation, as you have 2 Mariposa candlesticks here, one in the greens and one in the reds. Very, very interesting. Now, I would also have a look at the S&P 500, which tends to maintain a median between the two previously seen, the NASDAQ and Dow Jones. You can see here that the correction lower is still present, like in NASDAQ, but not as intense. And at this point, we tend to maintain a bullish outlook for the index. Allow me to readjust the chart just a bit. And beneath the daily chart, you can see also the RSI indicator, which has corrected a bit lower, but remains at the reading of 70. It's actually at 69, which is not a major correction, as was the case in NASDAQ. Nevertheless, we tend to maintain our bullish outlook. And should the bulls actually take charge of S&P 500's direction once again, I would expect a breach of the 4950 resistance line and the index to start aiming for the 5100. Now, beyond US stock markets, I would be also highlighting gold as a very interesting trading instrument at the time of the release of the Fed's interest rate decision. Let's have a look. This is gold's 1 hour chart. And I would be switching this into the daily chart. You can see how there has been an upward movement. Now drilling back to the 1 hour chart to show a more clear picture, you can see how the precious metals price is forming continuously 1, 2, 3, 4, 5 higher truths, and you have at the same time 1, 2, 3, 4, 5 higher peaks, with the last one being very interesting. Now, if we drill out once again, so I zoom out, it's a very narrow slope, but the RSI indicator tends to remain between the readings of 50 and 70, actually closer to the reading of 50, implying that there is some hesitation of the market for bullish sentiment here. Nevertheless, should the bulls maintain control over the precious metals price, I would expect the price action to breach clearly the 2038 resistance line, which is being tested right now once again, and in that case start aiming for 2075. Mind you that volatility is very low, very, very low for gold's price, and it's characteristic how the Bollinger Bands have narrowed. On the fundamental level, the Fed's interest rate decision could weigh on gold's price should the bank actually maintain a dovish tone, a hawkish tone. And I'm saying that because we have a negative correlation between gold and the US dollar. And, or at least that's a perceived negative correlation. So should the bank actually issue a hawkish interest rate decision, that could provide some support for the US dollar, which in turn could weigh on gold's price. On the flip side, should the bank remain uncertain and issue a dovish or more tilted towards the dovish side interest rate decision, that could weaken the US dollar and actually cause gold's price to rise substantially. It's going to be a very, very, very interesting 1.5 to 2 hours in the late American session today. Another interesting pair, which we should keep in mind, would be GBP USD, this time in the FX market. Now, GBP USD has maintained a clear-cut sideways motion between the 1.2780 and the 1.26. It's very interesting, and allow me to highlight this. You can see how the price action is being maintained between the pre-mentioned levels. Allow me now to raise it. There you go. So we have a sideways motion which we expect to be maintained. And that's being based practically on two indications, three. One is the sideways motion of the pair over the past 1.5 months. I would be also noting the narrowing of the Bollinger Bands, implying that there's low volatility for the pair, and also note how the moving averages have flattened out. And it's characteristic that in this case, the green line is the 100 moving average and the orange line is the 200 moving average. Note how they are moving in parallel without even threatening to touch each other. On the flip side, we have an RSI indicator which has been dropping and it's currently now below the reading of 50. And that has been happening since the 24th of January. So we're talking about a week ago. So it seems that slowly but steadily a bearish sentiment seems to be building up for cable. And should it intensify, causing possibly a selling interest on behalf of the market, then we may see GBP USD actually breaching the S1 1.26 and start aiming for the 1.2445. In this scenario, I would also require the price action not only to fall, but to fall beneath the S1 and use the S1 as a resistance line. That would be a clear indication for a bearish outlook. On the flip side, should the bulls take over, we may see the price action rising, breaching the 1.2780 and start aiming for the 1.2880. The interesting part about cable is that on the one hand, it has today the Fed's interest rate decision, which could create a wide volatility. Tomorrow, you get BOE's interest rate decision, which could affect the GBP side of the pair. And on Friday, we have the US employment report for January, which once again could be affecting the USD side of the pair. So we may see the pair having increased volatility over the next couple of days. Once again, though, for the time being, we tend to maintain a very tight sideways movement bias between the S1 and the R1. And we're talking here about 180 pips corridor, which, considering the volatility of the pound in the past, is, in my opinion, quite tight. Now, it would be more interesting if I drilled out of the chart into the daily chart. That's it. You can see how the pair was able to rise or fall far more intensely and for a longer period, and now remains in a very tight sideways motion. Okay, back to the H4 for our chart. We're adjusting it. And at this point, I would also like to have a look at AUD/USD. Daily chart. Readjusting it. Let me adjust the labels as well. Now, what's going on with the Aussie? You know, we had the release of Australia's Q4 CPI rates, and the headline rate actually slowed down more than expected on a year-on-year level, reaching 4.1% year-on-year. And in my opinion, that was one of the detriments which actually caused the Aussie to fall during today's Asian and early European session, despite some corrections higher later on. But the fact that Australia's CPI rate has slowed down beyond expectations would be an additional factor which practically RBA has now to price in. If I'm correct, there should be an interest rate decision of RBA within 6 days from now. That will be next week. So more or less, that may cause RBA to actually maintain a less hawkish, or even if you prefer, a dovish or uncertain stance, which could weigh on those even further. On the other hand, I would be noting also from China the release of the NBS manufacturing PMI figure. Now, the indicator's reading actually rose from 49 to 49.2. The rise as such was expected. The issue here in my opinion, is not the rise as such. The rise was practically material. The fact or the main takeaway from the release was that there was another contraction of economic activity for the Chinese manufacturing sector in the past month. And that, in my opinion, was a negative for the Aussie on a fundamental basis, given that Australia is a huge exporter of raw materials towards the Chinese manufacturing sector. It's understandable that should economic activity in the Chinese manufacturing sector continue to contract, then we would expect also less exports of raw materials from Australia to the Chinese mainland. I would be also highlighting here the release of the Caixin PMI figure. If it's not already out, give me a sec. It should be out this morning. Yep. Yeah. It's expected practically during tomorrow's Asian session. And at this point, it would be interesting to note that the expectancy is for the Caixin manufacturing PMI figure to drop slightly from 50.8 to 50.5. However, that would imply that it remains marginally above contraction levels, more or less implying a slight increase. So we're getting some conflicting messages here. Yet the overall picture of Chinese factories actually struggling to increase economic activity is there. And this uncertainty, in my opinion, tends to be a negative for the Aussie. Okay, let's have a look now on a technical basis how this is working out. Once again, back to the forward chart, we tend to maintain the basis for the sideways motion of the pair between the R1 and the S1. We're talking about here 95 peeps, 95 peep corridor. And the RSI indicator, despite dropping below the reading of 50, has narrowed it again, more or less remains rather unconvincing for any bearish tendencies of the pair. For a bearish outlook, I would require low show than this one. So the price action has to fall, breach the S1 0.6525, and start aiming for the S2 0.64. On the flip side, should the bulls take over, we may see the price action of AUD/USD rising, breaching the R1 0.6620, and start aiming for the 0.6725. Let's have a look also at WTI. Wide drop during today's European session. Haven't researched that yet, but it's interesting. Let's drill into the daily chart. Weird chart. Yep. There's a relative hesitancy on behalf of the market about the price action of WTI. It seems to have hit a ceiling on Monday at the 79.15. Back to the forward chart. Yeah, that's clear cut. Let's have a look when that was exactly. Yep, that was on Monday, the Asian session. and has corrected lower and remained rather stable. You could also highlight this by the breach of the upward trend line. So that's a game changer, given also the fact that the RSI indicator has dropped to the reading of 50, implying a rather indecisive market, or at least that the bullish sentiment has faded away. Also note how the Bollinger Bands have narrowed, showcasing low volatility for the pair. On the other hand, we have the moving averages, which are still pointing upwards. It's the 100 and the 50. I'm switching the bullish outlook of WTI right now towards a sideways movement, and I'm setting as possible boundaries to the upside the R1 79.15, a level which was beautifully tested here. On the other hand, we have to the lower side the 75.25 support line, a former resistance line. It could rise slightly to meet this level. That would be the 75.65. So practically, for a change of hearts here from a sideways motion bias towards a bullish outlook, we would require a higher peak than this one. So practically it has to breach the R1 79.15. While on the flip side, for a bearish outlook, I would require a clear break of the S1 75.65, a level which was tested here to the downside, but also aimed for here, tested, aimed, tested. So that's pretty valid as well. We have a very wide corridor though, which follows between the S1 and the S2, yet the sideways motion, the wide sideways motion, you can see it, which was present from the end of December up until the mid 17th to the 18th of January, dictates such a wide corridor. So that should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
Everyone, my name is Emily. In our video today, we will talk about why having a forex trading strategy is important. Trading on the global forex market presents the opportunity for a quick profit turnaround for traders and offers significant potential. However, as the most liquid market in the world, it is both complex and highly competitive. This means that in order to be successful, you need to have a solid trading strategy in place. Forex can be traded in numerous ways, so it is very important that you go with an approach that suits your experience level, budget, and trading goals. Having a proper understanding of the market you're entering into and the strategy that is needed can be the difference between trading success and failure. Choosing a forex trading strategy is similar to buying a new car. There are a lot of choices and they come in different types. It is also important that you test drive a new strategy via demo account before proceeding with it on the real world markets. Thank you so much for watching us today, guys. Bye-bye.
Okay, thanks for waiting, everyone. Let's go ahead and get started. So, welcome to this week's webinar on the second part of our Fibonacci series, which will be on Fibonacci extensions. So, before we get started, as per usual, a risk warning. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so I'm Melanie. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here is our agenda for today. We will do a brief recap of the Fibonacci retracement essentials that we went through last week. And then we'll look at ideal market structure. So what are considered significant swings, how you can follow market trends, and then the different Fibonacci retracement levels, followed by this week's Fibonacci extension slides. So then we'll look at Fibonacci confluence and how you can combine what we learned last week, so Fibonacci retracement, with this week's extensions. Okay. Feel free to let me know in the chat throughout the webinar if you guys have any questions. Let me just change the settings so that you can ask me in the chat or Q&A. Okay, should be okay now. Okay, so let's get started. So starting off with a quick history lesson on the origins of Fibonacci. So Fibonacci retracement levels were named after Italian mathematician Leonardo Pisano Bigolo, who was famously known as Leonardo Fibonacci. So, however, he did not create the Fibonacci sequence. Instead, he introduced these numbers to Western Europe after learning about them from Indian merchants. So Fibonacci retracement levels were formulated in ancient India between 450 to 200 BCE, and the sequence is also referred to as nature's numbering system. It's often observed by known people in flower patterns, hurricane patterns, and galaxies. So here's our recap on last week's Fibonacci retracement. So a very simple checklist to follow when you're first starting out with Fib retracements, and I guess some things to look out for. So firstly is the market structure clear. So we want to look for big zigzag patterns, and we'll show you some examples in the coming slides. Next, we're looking for recent trends. So we want to identify, is the trend going up or down? And it's always important to follow the general trend. Next is to identify recent major swing lows or recent major swing highs. Again, we'll show you some examples of those. And we want to connect the two extreme points like you see in this slide here. So we're starting in this example because it is a downtrend. So we're starting from the highest point and then ending at the lowest point for a downtrend. And then if it's an uptrend, we're looking at the lowest to highest points. So here's an example of a clear market structure. Okay, so although Fib retracements and all the different Fibonacci techniques can be used in both choppy and trending markets, it's still important to look for clear market structures, regardless of what technique you are using. So here's an example of a clear market structure, and here's an example of an unclear market structure. So one of the ways to identify a clear market structure is actually by adjusting the time frames in order to, get a clear market structure for you to conduct your Fibonacci analysis on. Okay, so what may look messy on a M30 chart might actually look very clear on an H4 chart. So if there's too much chaos in the shorter time frames, it doesn't mean that the entire currency pair is not able to be analyzed at that point in time. So it just could simply mean that you need to take a step back or sometimes a step forward to get a clearer view. So in this example, you can see we have a pretty unclear market structure from the 15-minute time frame. So it's quite messy. There's no clear movements in price, and when we change it to the 1 hour time frame, you can see that the highlighted portion has a much clearer market movement. Okay, so there's basically two criteria that you should look out for. Firstly is a clear swing low. So the clearer the swing high, the clearer the trend between these 2 points, and the more accurate your Fibonacci retracement will be. Okay, so I guess now we'll briefly go through what conditions to look out for when we're using the retracement tool and how we can use it on both MT4 and TradingView. So if we have time at the end of this webinar, I will do a brief market analysis. Feel free to let me know if you have any requests in the chat, and we can do a bit of Fibonacci analysis on TradingView as well. But starting off with MT4. Okay, so here's just the layout on MT4 if you're unfamiliar. So now let's zoom into our toolbar. So when you hover your mouse over this option, where my mouse is here, it should say draw Fibonacci retracement. So you just click on that, and you can click on wherever you want your Fibonacci retracement to be. So it should come out looking like this. And if you want to add or edit any Fibonacci levels, you simply right click on the Fibonacci trend line, and then so it's pretty faint over here. There is a red dotted line. Yeah, but this is what you will get when you right click on it. So you click on Fibo properties, and then under the Fibo levels tab, you can then click add, and you can proceed to add whichever levels you wish. Okay, so here you can see, yep, it'll look like this. I click add, and then I've added a negative 0.618 level, which is essentially just minus 61.8%. Okay, so now looking at Fibonacci retracement tool on TradingView. Okay, we have a typical layout. In this case, we're looking at pound dollar for this example. But basically, you click on the Fibonacci retracement tool, which is the symbol with the 4 horizontal lines over here. So you can find this, I think you can find this on the top bar or the sidebar. Yeah. Here you can see I've circled it out. And then after you've connected your Fibonacci trend line, this floating bar will pop up over here. So when you click on settings, this selection box will appear. So you can select any other levels that you wish. So if you weren't here for our previous Fibonacci session, I'll show you guys in a little bit, but depending on which Fibonacci technique you're using, we will look at different levels. So let's say, in this case, I'm looking at all of the relevant levels from negatives to more than 100. And when you're first analyzing the levels, you want to kind of select both negative, mid-range, and above 100 so that we can view all 3 Fibonacci types at once. So this is what I mean here, from minus 61.8 to 161.8. So the negatives are what we call Fibonacci expansion. Okay, today we are going through the above 100s, which are the Fibonacci extensions. So we are using the 127.2 and the 161.8. And next week we'll be looking at the expansions, so the negative levels. And last week, the retracements, we looked at the mid-range levels, so 23.6 to 78.6. Okay, so yeah, we'll go through expansions more in depth in the next webinar. So I'll just briefly introduce these levels now. And if you look at the GIF that I've included here, this is the kind of shape that we're looking for. And this is how exactly you should draw your Fibonacci retracements. Okay, another example here, you can see all the different Fib numbers that we mentioned in the previous slide and how it looks drawn out. So basically just take note of the starting point and the ending point of your Fibonacci trend line. So in this case, you can see the general trend that we're looking at is a downtrend. So the starting point is 100%, ending point 0. Okay. In this case, this is also another example, and we can see that price bounced off the highlighted area of 61.8% at the Fibonacci retracement level here. Okay, here's another example. In this example, we're looking at the 38.2% Fibonacci retracement level, and this is in line with the overlap support at the 32544.21. So you can see price bounced off of this highlighted area here. So if you are unfamiliar with what an overlap support is, you can stay tuned for our support and resistance webinars where we go really in depth into overlap and pullback support and resistance. But really briefly, overlap basically means that there are swing highs and swing lows that match up at the same level. Okay, and those tend to be really powerful or really significant levels, especially if they line up with our Fibonacci level that we have over here. Okay, another example here. So here we have two Fibonacci retracements. First one is from the top to the bottom over here. And we have 61.8% that lines up with our 0.92637 level. Okay, and next we have another level, or rather another retracement from the bottom to the top over here. And we have 61.8% Fibonacci retracement again that lines up with the 0.91614 level. Okay, and for this level, we actually have it matching up with two swing lows. So this makes it a pretty significant level. Okay. Okay, just a really brief example of an expansion. So for an expansion, we are looking for a flash kind of symbol or lightning bolt symbol. So here you see in this example, it kind of looks like a lightning bolt from the arrows. So starting point is here, ending point is point 2. And here we're looking at the negatives, as I mentioned earlier, for expansion. So expansion, we're looking at minus 27.2 as well as minus 61.8. So in this example, we can see the 61.8% lines up with this swing high here. So we're expecting price to bounce off of the 61.8% level. Okay, and we're projecting it to hit down towards the minus 27.2%. Okay, and you can see this is the outcome of that. So you really have confirmation that price is going to hit downwards once price breaks out of your initial ending point, which is at point 2. So that's how you combine a Fibonacci retracement with your Fibonacci expansion, since they both use the same tool, just that we're looking at different levels. Okay, so you can see here, once price broke below our ending point at point 2, we have confirmation that it's going to hit towards our minus 27.2, which it did, and it bounced up nicely from the minus 27.2% Fib retracement and hits back up to the ending point, which it normally does after bouncing off either the minus 27.2 or the minus 61.8. Okay, so let's get into this week's Fibonacci extension. So here is an example of price reacting off the 161.8% Fibonacci retracement level, resulting in a reversal. So in this case, extensions, we like to look for Nike tick shapes. Starting at the starting point will be here, ending point over here. So we are taking, how you draw your trend line is you're basically drawing the head of the tick. Okay, and the projected level is either 127.2 or the 161.8 like we see here. So price has broken out of the 127, so we're projecting it to bounce off of the 161.8, which it did, and results in a reversal over here. Yeah, before we move on, I'll just show you guys the Forex Army page. Let me see. Okay, so in this website, you can see how exactly you can draw a Fibonacci retracement correctly. So, yeah, basically everything that I've gone through today, last week, or future webinars, most of the information will be over here. So you can see the clear structures that we went through earlier, how you can follow price structure, yeah, and this clear steps on how to draw your Fibonacci retracement, some examples. So feel free to check out this website after this webinar. Yeah, it also goes through Fibonacci confluence, which might be a little bit confusing since we are combining all the techniques. Yeah, so you can see over here, we have a bunch of examples. So yeah, let me just pop it into the chat for you guys. Okay. Now let's look at when does a Fibonacci retracement become invalid. Okay, here. So one of the most common scenarios of this is when price makes a lower low. So assuming you are drawing a Fibonacci retracement from the top to the bottom, or if there are bars on the right that break your ending point, then it becomes invalid. So I think we have a bunch of examples of this later on. Yeah, so just because it becomes negative doesn't mean that it is invalid, because we've already gone through that Fibonacci expansions are negative levels. Okay, but I'll show you guys some examples later on. Okay, let's combine some Fib retracements. So we have 3 different methods here. Firstly, we have the minus 27% Fib expansion. And this lines up with a 161.8% Fib extension, and then the 78.6% Fibonacci projection. So what we want to take note of from this example is basically the shape of all of these trend lines. So firstly, the extension, you can see the Nike tick. Over here, it's kind of an inverted Nike tick. So the head is here, the gray arrow, and then the tail would be the long black arrow. Fibonacci projection also uses a lightning bolt shape similar to the expansion, So you can use those together. So Fibonacci expansion, you can see the trend line that we are following from the red arrow. And then for Fibonacci projection, we're looking at the black arrow. Okay, and we can see that price bounced off of the Fibonacci confluence area over here. So that's how you use confluence. Another example, here we have 61.8% Fibonacci retracement matching up with a 100% Fibonacci projection. So in case you can't see the lightning bolt shape, I've drawn out the arrow. So the yellow arrow here is the Fibonacci projection, and the blue arrow, which is just a one straight line, is your Fibonacci retracement. Okay, and we can see price bouncing off of that confluence area there. Okay, another example here. So here we're using retracement and projection. So the 23.6% Fibonacci retracement is just one line following from this bottom here to the top here. And that is in line with our 61.8% Fibonacci projection. So for projections, it's 3 points. So we have a starting, middle, and ending point. And we can see price testing this level here. Okay. Okay, so let's backtrack a bit and look at how exactly you can use these retracements. So how do you identify clear market structures? Firstly, we want to look for significant swing highs, swing lows, significant trends, or clear market trends. So let's first look at an incorrect example. Here's an example of insignificant swings, which are bad points to use for starting and ending points. So you can see it's really messy, the price movements are too small, and there are no significant swing highs or lows. Another example is over here. So there's no clear swings, no clear market structure. Price movement is too small to use any kind of Fibonacci technique here. So here is an example of significant swings. Okay, we have a clear move up and down. We have obvious peaks and troughs, and very clear market movement as well. And here's another example. So I've drawn out the peaks and the troughs to show you exactly how clear it should be. Okay, and following the market structure. So we want to pick market structures with a clear upward or downward movement. So your Fibonacci retracement trend line can follow that movement. And this works better on higher time frames due to there being less noise. So by higher time frames, we mean H1 onwards. So H1, H4, daily, weekly, depending on your trading technique as well. Okay, so you can see this is an example of not following the market structure. So this is how not to draw a Fib retracement trend line. You can see we have a zigzag here, okay, but instead we are drawing a Fib trend line through the price structure, when instead we should be following it exactly. Okay, so when your retracement is cutting through the market structure, it makes it less effective. Okay, so for our Fibonacci extension, getting back to this week's topic, again, the tool that we use is Fibonacci retracement, and the percentages are 127.2 and 161.4. And here we're looking for a Nike tick, like you see in the GIF here. Okay, and these tend to be quite powerful setups. If they don't react off of the 127.2, then we're likely expecting it to react off of the 161.8. Okay, and these usually retrace the entire move from point 1 to 2, hence the retracement tends to be more than 100%. So the clearer the movement of the Nike tick, the better. So you can take a look at this GIF over here. So you can see it did test the 127.2 slightly, but it still broke out of it and reacted off of the 161.8 before reversing back down. Okay. Okay, so another example here. So for fib extension, in this example, we are looking at it reacting off the 161.8. And then we see a reversal here. Yeah, I think we saw this earlier, so I'm going to skip that. Here's another example. So this is on the daily time frame. And you can see that there is a swing high that's in line with the 127.2. It's quite small. So these, obviously, the clearer the Nike tick, the better. But if you have a small movement like this, that works as well. So if we zoom in, because this is on a daily time frame, so if we zoom in and view the same chart on a H4, we can get a clearer view. Yeah, so you can see here the Nike tick is a lot clearer. Okay, and this is on the same chart. So we can see how price reversed nicely off the 127.2% fib extension level here. Okay, and here earlier I briefly mentioned an inverse Nike tick. So in this example, you can see it a bit clearer. Starting point here, ending point here, and then the tail would be from the 0% all the way down here. Okay, so as long as it retraces 100% of the tick, then it can be considered a tick. You know, as long as it reverses 100% of the V shape, then it's considered a tick. So we want to take note of the swing low support at 0.91565 in line with the 161.8% level. Okay, so this makes it a strong support level where price bounced off of. Okay, so we'll talk a bit more about combining the different fib methods as well as the support and resistance levels so that it increases the accuracy of your analysis. Okay, let's move on. So we talked about invalid Fibonacci retracements earlier. Okay, and I did mention as well that the fib retracements that are negative are still valid. Okay, and this is an example here. So our starting point is here, ending point here. Price breaks our ending point, as we see from this area over here, under the red arrow that I pointed out here. And once it breaks out of it, it's no longer valid. So basically, when it breaks out of your 0.0% level and has made a lower low, that's an example of an invalid retracement. So you want to remember to always pick the lowest point with nothing on the right of the ending point. So your ending point is here. We don't want anything lower than that over here. Okay. Let's quickly get into Fibonacci confluence. We briefly talked about it, but I'm gonna get a bit more in depth into the extensions. Okay, so we looked at this example earlier, but it's basically multiple Fibonacci levels. It doesn't have to be retracement only. As long as there are Fibonacci methods that line up nicely, it's considered confluence area. So you're basically lining up these levels so that you can increase the probability of a bunch of Fibonacci levels working versus a single Fibonacci level working. Okay, so yeah, we looked at this example earlier. So in this example, we have two fit methods. Okay, I mentioned earlier the Fibonacci extension, which we just went through, and the Fibonacci projection, which uses a lightning bolt symbol. So our 61.8% Fibonacci projection, like you see here, lines up with the 127.2% Fibonacci extension. So the Nike tick if you can't see, the head of the Nike tick is from here, this swing low to this swing high. And because it has surpassed 100% of it, or it's retraced 100% of that, the head of the V shape, then we can use it as our extension. And for our projection, we are looking at the starting point here, middle point here, and ending point at the swing high. Okay, for projections, we use 61.8, 78.6, and the 100%. So here we're looking at 61.8, which lines up nicely with our 127.2% extension level. Okay, and you can see how price bounced off nicely off of that level. Okay, but in this case, you can see it's just the wick of the candlestick that's just touching that area. So we'll go through in a bit how exactly you can maximize your chances of catching this reversal, since it is just a candlestick wick. Okay, next let's look at another example. So here we also have two Fibonacci methods. We're using extension and projection again. Our extension here is not an inverse extension. Okay, so we have the hit, the starting point at the swing high, ending point at the swing low, and it retraces, it's past 100% of the V shape, as you can see here. So that's why we're looking at 127 and 161.8. Fibonacci projection wise, we are looking at the lightning bolt shape again. So starting point here, middle point here, and ending point here. Okay, so 100% Fibonacci projection lines up nicely with our 127.2. In this case, we can see that our 100% also lined, or rather our 78.6 Fibonacci projection also lined up nicely with the 61.8% Fibonacci retracement. Okay, but it already surpassed that, so it's no longer valid. Okay. Okay. Last example, I think. But basically in this example, we are looking at an expansion and an extension. So for expansions, remember we're looking at the negative levels. So for expansions, we're also looking for a lightning bolt shape. So the lightning bolt shape is like this. The minus 61.8% lines up nicely with our 161.8. So you can see that the minus 27.2 expansion also lines up nicely with the 127.2. So when we identify this confluence, these two confluence levels, we would first wait for price to break out of this confluence area before going in for buy towards this confluence area here. Okay, in this case, obviously it broke out of it, so we were going for that buy. But if we didn't know that it was going to break out of it, we would first going for a buy towards this area here first. Okay. Okay. Okay, this is our last example. So in this example, we have the minus 27.2% expansion, which is the blue arrow. Okay, and that lines up with our 100% Fibonacci projection, which is the lightning bolt shape. Starting point, middle point, and ending point, as indicated with the orange arrows. And then the purple is our Fibonacci extensions, or in this case, we have an inverse Nike tick. Okay, so we have minus 27.2, 100%, and 127.2 lining up. So we can see that price bounced off nicely off of this very strong support level. Okay, so normally you would try to get as many Fibonacci techniques as you can lining up at the same level, because that gives us a stronger confluence area. Okay, so it's a more effective indication that price is going to bounce off of that or reversal is going to happen. Okay, so let's talk a bit about trade management. So earlier I showed you guys how sometimes with confluence areas, you can expect a very brief reversal. So a very brief touch on our confluence area before it starts reversing off of it, especially when you have a very strong confluence area with multiple Fibonacci levels lining up on it. So in order to avoid missing your trade, this is the trade management technique that we like to follow. So firstly, your stop loss will be placed beyond. So this means that you would place your stop loss beyond a key Fibonacci confluence area. So the reason for this is because more often than not, price is attracted to such strong areas of confluence, and if your stop loss is right before instead of beyond it, you will most likely get stopped out before the market reverses. So that's basically what I mentioned earlier. In this example here, um, we're going in for a buy. Okay, so our stop loss will be placed below your Fibonacci confluence. And your take profit, we recommend you to place it before. So in this case of a buy entry, we would place our take profit below the confluence area. Okay, obviously these will be switched if you are looking at a sell entry. But yeah, basically the standard rule is that stop loss will be placed beyond a key Fibonacci confluence area and a take profit will be placed before it. So before means that you should place your take profit, in this case, below the confluence area. Reason for this is because when price reaches the confluence area, there's a high chance that it will not be able to go beyond it. And instead of reaching your profit target, it might reverse back to your entry or even worse, your stop loss right before it reaches your take profit. Okay, so that's also one of the reasons why people complain that the market is being manipulated because they miss their take profit by 1 or 2 pips. Okay. Okay, let me know if you guys have any questions. We still have a bit of time. So I'm gonna pull out my charts, and if you guys have any requests for any currency pairs you'd like me to go through, feel free to pop them into the chat. Okay, I got a request for DOW30. Let's go ahead and look at that. Mm, Can you just really quickly drop the ticker in the chat? I can't seem to find it on TradingView. Is it this one? Is it this? Okay, let's go ahead and analyze this first. Can you guys still hear me? Okay, let's continue. So, let's start off by looking at it on the higher time frames. Okay, so okay, we can see a general downtrend on our daily time frame. Let's look at our weekly time frame. Okay, weekly time frame is pretty bearish as well. Okay, okay, I'm just gonna go in and add some support and resistance levels. So here's our first resistance. Here's our first support. And here's our second resistance. Okay. Okay, let's look at our 4-hour time frame. So we kind of have the same levels here. This is our first support. Yeah, okay. Okay, let's look at Dow Jones. Okay, so same thing, we're gonna look at the higher time frames first. So it's pretty bullish, okay, on our weekly time frame, on our daily time frame as well. Okay, here is our first resistance. Okay, this is our first support, and I think this would be our second support. Okay. So if we're looking at our retracement, we're looking at the mid-range first. So we have these 5 levels. 23.6 to 78.6. And I can see that my 38.2 lines up nicely with my first support. Okay. Let's see. Okay, let's look at this on our 4-hour time frame instead. Okay, it's pretty similar. Okay, now I'm gonna look at a projection. So for projection, we use these 3 levels. Okay, and okay, actually here I can show you guys an example of a Nike tick. Okay, we're looking at the above 100 levels. Okay, so 127.2 and 161.8. And you can see the shape of the Nike tick here, right? So it's surpassed 100% of the V shape, which is why we can use it. And you can see price actually rebounded off of the 161.8 level, just as we suspected or would expect. Okay. So yeah, that's an example of the Nike tick or Fibonacci extension that we went through today. Okay, let's see. So because of that reversal of the 161.8, we can expect it to continue to go down towards this level now, which is our 23.6 level. Okay, so I might just put an indicator there. Let's see if we have previous levels. Okay, kind of have this level here as well. This would be just an intermediate level, okay, that I'm expecting price to hit towards. Okay, now let's look at some indicators. So I like to start off with Ichimoku and MACD. So if price is moving below the Ichimoku cloud, it is a bearish signal. And if it's moving above, then it's a bullish signal. So in this case, we see price moving above, so it doesn't support our analysis that price is going to drop down to this level here. Okay, so I'm going to get rid of that. And MACD, you can see that it does support my analysis. So I can keep that. And let's look at RSI and stochastic. RSI, you can see very obvious downtrend. So it also supports my analysis. Let's look at stochastic. Okay, stochastic as well. Okay, let's look at maybe Bollinger Bands. Okay, so you can see that on our Bollinger Band, price is moving out or it's breaking out of the bottom band of our Bollinger Band. So it's also supporting our bearish analysis. Okay, so out of the 5 indicators that we've used, 4 out of 5 of them have given us a bearish signal, which supports our analysis. Okay, so because there are so many indicators, 50% of them will give you bullish and 50 will give you bearish. So it's important to just learn a couple that you're comfortable using, that you know how to use, and then stick with those. Use those interchangeably to support your analysis. And yeah. Okay, any other requests? I think we have time for maybe one more. Okay, no worries. Okay, let's look at gold. So on our weekly time frame, it's pretty bullish, right? On our daily time frame, also pretty bullish. Okay, there's not a trend line, but let's see if we have a trend channel. Okay, I think we can see price breaking out of the trend channel. Okay, we might see it break out a bit. Okay, let's go in really quickly with some levels. So this is our first resistance, our first support, and our second support. Okay, on our 4-hour time frame, okay, I'll just show you guys an example of a Nike tick again. Here, okay, you can kind of see this Nike shape or tick shape. Okay, and you can see it bouncing off of the 161.8. Okay. Yeah. And okay, so this would be my first resistance. This is my first support, and then my second support here. Okay, so going in with a projection again, it's in line with my 61.8. Okay, my 38.2 lines up with my first resistance. Okay, and okay, I think that's about it. Okay, so my 23.6 also lines up with my first resistance, and so does my 61.8. Okay, so we have this confluence area here. And this is also a pretty significant level of overlap, okay, because we have a bunch of swing lows lining up as well. Okay, now let's pull out some indicators. Okay, price is moving below the Ichimoku cloud, so it's giving us a bearish signal. MACD is also giving us a bearish signal. If we look at RSI, okay, RSI isn't telling us much. Let's look at stochastic. Oh, okay, so we have a bit of divergence here. So price has made a higher high on our price chart, whereas on our stochastic, it's making a lower low. So this is a bearish divergence and could suggest that price is going to continue to break below our first support. Yeah, but we'll have to see because this is a pretty significant level here. So you might see a bit of a jump. Okay, if I zoom in, you can see price already increasing here. But ultimately, because of all the downward pressure, we might see it continue to drop below the first support. Okay, maybe let's look at moving averages as well. Okay, so the SMA and EMA price is moving below both of these indicators and it recently crossed over each other, which could suggest a change in trend. And it's been pretty uptrend recently, and now we're seeing a downtrend. So that could be because of that. So also supports our bearish um, analysis. Okay. Okay, I think that's all the time that we have for today. Um, Let me see if we have any other questions. Okay. Okay, if there's nothing else, thank you guys so much for joining me today. I hope you guys found it helpful. Have a great rest of your week, and I'll see you guys next week. Bye, everyone. Thanks, everyone. Bye.